is Sean O'Hara. He is the president of Pacer ETF. Sean, welcome to the show.
Good morning. Nice to be with you.
So, Sean, do you think it's misleading to rely on average monthly returns to make investment decisions when history shows that September has delivered both strong gains and sharp losses?
Yeah, I think it's a little bit dangerous to do that. I think you need to understand what's going on situationally within each of those months. If you compile statistics over time, September has been a challenging month, October as well. But in those periods where it's been challenging, you have to look at the economic backdrop. You have to look at where inflation is, where interest rates are, where earnings are, and where the overall mood of the investor is. And so I think, to just simply say, oh, September is a tough month, I think I'll stay out, can be a really dangerous thing.
And I understand this month you think the Fed meeting is really the most important factor to consider. Can you share more?
Yeah, I mean, I think the Fed's been behind the curve here a little bit. Their mandate is obviously inflation and the jobs. Inflation to me seems to be muted. It's not necessarily at that 2% target, but we've heard the chairman talk about maybe it doesn't need to be. But the real risk is the economy and jobs, especially since the revision of almost a little bit more than 1 million jobs that were sort of taken out of the numbers here recently. And so I would expect that they're going to cut in September. I would hope they cut 50 basis points, but I don't necessarily think they're going to. And then I think the most important thing then, once they announce what they're going to do, is to see what their guidance says. I think the market's been waiting all year for this last leg of this three-legged stool that's been a challenge. It's been the tax bill, it's been inflation and the Fed that have sort of been worrying investors or creating uncertainty. And I think we've got the tax bill done. It looks like inflation is really under control here. So this is the third leg. And I think once this announcement happens, and if in fact they do cut and signal that there's going to be more cuts, I think the market will be very happy with that, because now we'll have clarity.
And what do you think the pros and cons of a rate cut would be?
Well, I mean, the cons would be, if they cut and then they stimulated the economy too much and inflation came back. The pros are that, the housing market here in the United States has been sort of frozen, if you will. Interest rates are high. Investors or homeowners can't really move forward. And so I think, that housing has always been a big part of our economy. And so getting a little bit of interest rate relief there is going to be a good thing for housing, which will stimulate the economy a little bit. I also think that there's a whole lot of commercial real estate mortgages out there that with a little bit of relief. I think the banks have been carrying some of those folks or letting them just continue rather than making them refinance. And so if we get a little bit of help there, I think that's also a very positive thing.
And what else do you think investors should be looking at or considering this month?
Well, I think there's two things. One is earnings. Earnings have come back here now from single digits or low single digit growth to more than double digit earnings growth. And then the other thing that worries me is that the stock market in general, as we look at it, if you will, on TV, the S&P 500, the NASDAQ, the Russell 1000, all of those big broad indexes are really being driven by a very small number of names, 7 names to be exact. And when you look at investing, particularly in ETFs, you're investing in a broad market ETF that's cap weighted, which means that the majority of the weight goes to those biggest names. It's good when they go up, but it's a challenge when they go down. But there's also opportunity below the line. There's smaller names in those broad indexes that actually have had better growth than NVIDIA, have had better performance than NVIDIA. So if you stay cap weighted, you just don't get enough weight to those things. So I think finding a strategy to add to or complement your traditional cap weighting strategy that's not cap weighted, maybe it's equal weight, or maybe it's something like what we do, which is identify a metric, for example, free cash flow margin, can create portfolios where you get bigger allocations to those smaller names that are really underrepresented in the broad indexes.
Sean, are there any under the radar market storylines that you're following that you think we might hear about?
Well, I think there are. I mean, I think the AI trade obviously is a big deal. I think Oracle roared, back last week. And so now, they might have to be included in the Mag 7, but I don't think anybody expected that. But I think what they foretold was that there is going to be a massive amount of money invested in AI, particularly in data centers, and they're going to be a beneficiary. But they're not the only one. There are much smaller names as well in these broader indexes that are going to be winners as well. And so I think you need to look to that. That $3 to $7 trillion that's going to be invested to build out AI is going to benefit a lot of chip makers that are smaller. It's going to benefit a lot of software names. And so I would be looking to try to find places outside of the Mag 7, because they're going to be the spenders who are going to be the receivers. And I think it's all of those component parts inside of the data center. If those spends come in at $3 to $7 trillion, they're going to buy equipment and they're going to buy software and switches. And so they think that's an opportunity for investors, and that's something I'm excited about.
Thank you, Sean O'Hara, president of Pacer ETFs.
Thank you.